You're staring at your screen. A trade just went south, and instead of walking away, you double your position size to try and win it back immediately. Under the weight of that single loss, your discipline fractures. By the time the afternoon is over, a month of careful, patient gains is completely gone, burned up in a series of impulsive, oversized decisions that entirely ignored your trading plan. This is the core paradox of the intermediate trader. Why do individuals who understand complex market mechanics and mathematically sound setups still find themselves staring at a blown account? The hard truth is that mastering how the market moves is completely useless if you lack the psychological mechanism to control the person actually executing the trades. Psychologists call this downward spiral a cognitive bias cascade. It is a psychological chain reaction where your first emotional error, say jumping into a trade out of FOMO, creates an immediate frustration that actively degrades your ability to prevent the next error. This shows an uncorrupted sample size of trades. A strategy requires perfectly executed inputs like this to manifest its edge, but trading on fear forces actions entirely outside your model, injecting corrupted data into a pristine system. Once emotion corrupts your dataset, your edge disappears. You are left with absolutely no way of knowing if your strategy actually failed, or if you simply failed your strategy. To clean up your data, you need to change how you categorize your trading results. You must stop viewing losses and mistakes as the exact same thing. This balance sheet illustrates the reality of proper risk. A loss is simply a statistically probable outcome. If you calculated your risk and executed strictly according to plan, that negative trade is a standard business expense, calmly categorized as expected operating costs. A mistake is a self-inflicted wound. It is an action driven by emotion rather than strategy. And here is the crucial distinction. It remains a mistake regardless of whether that specific trade actually makes or loses money. Because of this distinction, you can have a completely flawless day of execution that consists entirely of financial losses. Conversely, you can have a highly undisciplined, terrible day where you broke every rule and simply got lucky. Elite professionals completely divorce their daily assessment from their profit and loss statement. They evaluate their performance based solely on the purity of their execution. To enforce this execution purity, you use the 3-mistake rule. This is a self-imposed, non-negotiable circuit breaker designed specifically to physically stop the cognitive bias cascade. Step 1 happens before you look at a chart. You write down brutally honest, personalized definitions of what constitutes a mistake for your specific strategy. Moving a stop loss, engaging in revenge trading, sizing up inappropriately, define your personal triggers. Step 2 is the real-time tally. During the live session, every single time you make a fresh, distinct choice to break one of your predefined rules, you record a mark. Step 3 is the shutdown. The exact moment that third mark is recorded, you close all open positions at market value. You do this immediately, with absolutely zero hesitation or second guessing. Modern trading platforms allow execution in fractions of a second, meaning these emotional chains can compress into mere moments. Your absolute best operational defense is your own honesty in tracking those rapid-fire errors as they occur. Closing the software and physically walking away from your desk severs the emotional feedback loop. By removing the visual stimulus of the chart, you protect your capital from further destruction. Hitting your 3-mistake limit is not a personal failure. Slamming that door shut means you successfully deployed a massive risk management defense. What happens next is the blameless review. This is a post-market analysis ritual performed hours later, strictly after the emotional charge of the live session has entirely dissipated. You open your journal and ask yourself 3 core questions for each tally mark. What exact rule did I break? What physiological feeling did I experience right before the error? And what specific market action triggered that feeling? Dwelling on the money you lost is useless, but identifying that fast, volatile price action triggers your impatience and forces you into poor entries, that is high-value intelligence. This objective, blameless analysis strips the judgment out of the error. It turns a volatile emotional breakdown into a highly structured, concrete blueprint for improving your execution in tomorrow's session. Long-term profitability in the markets is never about trying to win every single trade. True, scalable consistency is the direct result of applying a pristine data filter, your 3-mistake rule, to protect a mathematically sound strategy. By ruthlessly cutting out the days where you are emotionally compromised, you prevent the catastrophic cascading drawdowns that typically end retail trading careers entirely. You can implement this system today. Download the free FXNX trading journal template to clearly define your mistakes and apply this exact framework on regulated FXNX MT5 platforms. You have to protect your edge from yourself. The market will do whatever it wants, but your own mental state is the only market variable you actually have the power to control.